Hello, everyone, and welcome to Wescott's latest webinar. This is our year-end version. This is the year AI got real. My name is Mark McCarron. I'm the Chief Investment Officer here at Wescott. And today we're going to look back briefly at 2025 key themes, and we're going to look forward to 2026. So why don't we get started? So we'll start real quick with looking backward. So if you look at 2025, this is our Wescott wrap for the year. Stock markets reached new highs during the year, despite a lot of risks, persistent inflation, tariffs, unemployment is rising a little bit, and a government shutdown. Yet that didn't stop the markets from producing double-digit returns. The key theme for the year, as the title suggests, is the insatiable demand for generative artificial intelligence microchips. So it's hard to say, but generative AI was the main theme. We're going to dive deep into that. The other main theme that I would say is the US dollar, which has been a strong currency relative to the rest of the world for the last decade, began to weaken because of the shifting trade flows and some concerns around what tariffs might do. And that meant that the currency weakened, and that really helped international markets. And the final big theme, I would say, is the Federal Reserve policy shift. The Fed cut rates 3 times in 2025, each by 25 basis points, so for a total of 75 basis points. And on the right-hand side, we're just showing the performance of the markets. So first, the S&P 500, which is the standard benchmark that many people look at, is up, 18%. The international markets are up over 30%, with a lot of help from that weakening dollar. I do want to point out, though, that there is a little bit of a difference or a gap between the S&P 500 standard market cap weighted and equal weighted. And the real driver of that is the top names in the market cap benchmark dominate. So when leadership is narrow in the marketplace, it's the S&P 500 market cap weighted benchmark that outperforms. And when the rally broadens, like it did at the beginning of the year, the equal weighted version of that same index outperforms. And it's really important to note that the impact of the largest companies in the stock market have been so significant this year. And you can see the big drop during the tariff announcements at the beginning of the year. Well, that's been fully recovered and then some. And that was broadly based for a while, but the last couple of months, it's been all about AI. So let's talk about what AI actually is. So we wanted to talk a little bit about what the ecosystem in artificial intelligence looks like today and into next year. And there's great research out there by BCA Research, something we use here at Wescott, and they organized the world of AI into 3 categories. First is the enablers. Those are the ones that provide the infrastructure needed to train and monetize these AI models that everyone's using. The monetizers in the middle, they're the ones that provide the AI software and develop the models. And then on the right-hand side are adopters. Those are the end users, maybe some of us, consumers and households, but mainly businesses that are going to take this new technology and make themselves more profitable. So I just highlight the enablers on the left-hand side include NVIDIA, Advanced Micro Devices, Broadcom, ASML Holdings. These are the chip manufacturers that are, you need the chips to make the AI work, if you will. In the middle are companies that we're all familiar with, Alphabet, Alibaba, which is Chinese-based, Amazon, Meta. I threw an OpenAI here and a few other private companies. That's what the red is. And those are companies that are really in charge of driving the models that we're all using. And then on the right-hand side, the adopters include, companies like Amazon, Meta, which is Facebook, Microsoft. And actually, I would put Microsoft into the monetizers category as well, because they are a big owner of OpenAI, which is private. So that's really how Wescott clients get access to OpenAI. And the final thing I'll say on this chart is that while the enablers have been really the driving force behind the stock market run this year, Wescott clients have exposure to all of these companies, and we want to make sure that we're there when the evolution in the AI or ecosystem occurs. And that includes investing in non-US markets and in Chinese markets, which have been one of the best performing markets this year. So we'll go down and play a game here, or I think it's a game, but I basically said what I wanted to test what AI thought of the AI ecosystem. So I asked Microsoft 365 Copilot. I put a prompt in. The prompt was create a visual diagram showing the AI hyperscaler ecosystem. And this is what it came up with, which is sort of the same framework that we just talked about before with the hyperscalers, which are the big players in the middle, mainly the monetizers, and NVIDIA over here on the specialized hardware, the enablers, and the cloud platforms on the other side, generating AI services for all of us adopters. So it's kind of an interesting way. I think AI knows what AI is, and we are seeing its impact in our everyday lives. But I wanted to just focus a little bit more on what it's doing to the stock market. There's been a lot of press recently around bubble talk. The S&P 500, which is shown on this chart, as we just talked about, has been driving higher over the last many years. The last point on this chart is as December 16th of this year. It's at an all-time high in terms of a price, and it's nearing an all-time high in terms of a valuation. 22.1 times earnings is close to what it was in the late 90s. And the late 90s was the last time there was a dot-com bubble. So basically, we're looking at this and asking ourselves, how much risk is there in the stock market? But I want to be very careful. We're talking about the stock market as it relates to the S&P 500 market cap weighted index, which is a very narrow and less representative of the global economy and more representative of AI and the tech nature of the market. So we're not going to say that we're not concerned. I would say we are thinking about valuations very carefully. 22 times earnings is not cheap, and we're at near all-time highs. And it's been the generator, the enablers that have generated that return. So when we look at the S&P today, this number, 41.1%, represents the weight of the top 10 companies in the S&P 500 index as at the end of November. And it's not really different today. That is a very concentrated market and index, and more concentrated than it's ever been. So I want to put that into context because at Wescott, we don't only invest in the US stock market, of course. We also don't only invest in technology. We take a very diversified approach to what we do because, first and foremost, economic and market conditions can change very quickly and in unpredictable ways. We've already seen some evidence of weakness in some of those technology names that were listed on that slide before, because any expectations that are missed, the market's going to penalize that stock price. We don't want to have too much exposure to that risk. At the same time, we want to have an allocation to that area of the market. So just in general, Wescott portfolios are constructed really with a variety of different exposures at all times to position for the opportunities when they arise. So we're in the market when those market opportunities present themselves. But we're also building a portfolio to protect against any unanticipated risk, whether it's a spike in interest rates or it's a drop in valuations of the tech sector or a recession. We want to be ready for whatever comes next. So portfolios that we build have allocations to high quality bonds, which are over here. We also have infrastructure, real estate, alternatives, international markets, all of which are really there to diversify and provide returns that are less reliant on those names. But I just highlighted here too, if we think about the US top 10 companies as a category of itself, by itself, a portfolio managed by Wescott in general would have approximately 12% of its allocation to that category. And I would compare that to the rest of the US stock market out in the US. Outside of those top 10, we have about a 20% allocation. And this, by the way, is for a balanced portfolio of 60%, roughly 60% stock and stock-oriented investments, and roughly 40% on the bond side. So you can see that it's important and probably most appropriate to look at this category almost separately because the top 10 names are so dominant. But I wanted to highlight that because what we are not doing is putting all the eggs into that one technology basket, but clearly it's a theme. It's a theme we've had a good exposure to. But when that ecosystem broadens, when it goes beyond the enablers and into the adopters, that's really where the rest of the portfolio will really take charge. And that's what we anticipate occurring starting in 2026 and moving forward. So we wanted to give you that update. We, again, thank you for joining us today. Thank you also for your continued trust and confidence. Happy holidays to everyone. I hope everyone has a great holiday week and happy, healthy, and prosperous new year. Thank you.